Elliott Fund Management is one of the world's biggest hedge funds. It manages over $56 billion in assets. It has warned its clients of an extremely challenging situation for the global economy and for markets, where investors will find it difficult to make money. The world is on the road to hyperinflation and could be heading towards its worst financial crisis since the Second World War. So they went on to point out that investors should not assume that they have seen everything just because they had experienced crises such as the 1970s bear market and oil price shock, the 1987 market crash, the dot-com bust, or the 2008 financial crisis. It says, forget about all those things you have seen. The warning came as we have seen a dismal year for markets in which equities have shed $28 trillion in value according to Bloomberg data, and bonds have tumbled, leaving few places to seek shelter according to them. The fund manager laid much of the blame on central bank policymakers, who it said had been dishonest about the causes of high inflation by blaming it on supply chain bottlenecks in the wake of the pandemic rather than on ultra loose monetary policy put in place at the height of the coronavirus crisis. The world was on the path to hyperinflation, it said, which could lead to global societal collapse, civil or international strife. While such an outcome was not certain, this was the direction the world was heading to, the company indicated. So its warnings also comes as investors try to assess the economic damage likely to be felt from a rapid series of large rate rises we have seen from central banks, especially the Federal Reserve, in a bid to curb inflation. The S&P 500 has dropped 20% since its peak earlier this year, at the start of this year, while the Nasdaq is down a third since its high a year ago. Elliott Fund Management said markets had not fallen far enough given the main risks present, and warned of a further reversal of the everything rally seen near the top of the bull market, as sky-high exuberance lifted all manner of risky assets. There were so many frightening and seriously negative possibilities that it was hard not to think that a seriously adverse unwind of the everything bubble was coming, the company indicated. The hedge fund estimates that a 50% fall from peak to trough would be normal, suggesting further larger declines are to come in major equity markets, although it was impossible to know whether or when that would happen. Elliott, which is up 6.4% in 2022, has only lost money in 2 calendar years since its inception in 1977, when this man, Paul Singer, founded the company. So it has only lost money in 2 calendar years since that time. So it highlighted a few areas that could lead to market falls. One of them, or rather some of them, are bank losses on bridge financing, potential markdowns of collateralized loan obligations, and leveraged private equity. So bridge financing is here. Bridge financing is here. You can see that it's a form of temporary financing intended to cover a company's short-term costs until the moment when regular long-term financing is secured. Thus, it is named as bridge financing since it is a bridge that connects a company to debt capital through short-term funding. And then the other one, collateralized loan obligation. Collateralized, or CLOs, are a form of collateral or securitization where payments for multiple middle-sized and large businesses, their loans are pooled together. So collateralized loan obligation, that's what it means. A large pool of small and large business loans. When they are all put together, it's known as a collateralized loan. So it's the company is saying that markdowns in this sort of market is likely to lead to market declines, yet more market declines. The other one the company mentioned is leveraged finance. Leveraged finance is the use of an above normal amount of debt as opposed to equity or cash to finance the purchase of investment assets. So these are some of the areas that a company has pointed out that have potential risks to the markets. Bridge financing, collateralized loan obligations, and leverage financing. Obviously, they all make sense. All largely about debt. Okay, so you see the link to what I just read out to you now. You see this link in the description box below, and see how you make a sense of all that's going on. And this is Paul Singer, the founder of Elliott Management as of 1977. And thank you very much for watching this video.